Hello everyone, and welcome to our first PowerPoint of Unit 4, Area Study 1, Part B, kind of like where we start talking about monetary policy, which is essentially how the RBA manipulates interest rates to manage aggregate demand overall. So, as it says here, managing AD using monetary policy, basically just interest rates and how they're changed. It follows exactly the same structure and logic as the budgetary policy topic, in that we look at what it is, how it affects the economic goals, the macroeconomic goals, and some strengths and weaknesses of it. What just gets a little bit more complicated is when we look at how the RBA makes changes in the short-term money market, but that is a problem for another day. So in the key knowledge, what we're going to look at today is a couple of little things. We're going to look at the role of the RBA with respect to its charter, and then we're also just going to briefly kind of touch on what monetary policy is and how it impacts the government's macroeconomic goals. So to get into it a little bit further, let's move on ahead. So monetary policy is a branch of macroeconomic policy operated by the RBA, which is designed to regulate the level of aggregate demand and economic activity and relies most heavily on changes in the interest rates to alter the cost, availability, and demand for credit, or borrowed money, as it is also known. So interest rates refer to the annual cost of borrowing credit or annual return on invested savings, and rates are closely related to a nation's inflation rate and are largely determined at equilibrium in financial markets by the forces of supply by savers and demand by borrowers. What that means is essentially if there's a lot of demand for borrowed money, it drives interest rates up, and if there's not a lot of demand for borrowed money, it pushes them down because there's greater supply of money to lend out. How interest rates work, if you don't know this already, or you've just not really ever thought about it in too much detail, interest rates are basically either an incentive to borrow or a reward for saving. So when interest rates are high, say for example, if interest rates are at 10%, which seems insane at the moment, if you were to save $100, you would get 10% extra for every period that they save for. So if it was 10% per annum, it would mean that every year you would get an extra $10 on that initial $100. On the opposite side of things, they're an expense for borrowing money. If you borrow money, you have to pay interest, which is the bank's reward for lending you that money. So you often see that with credit cards. Like some credit cards are insane. They charge up to 17 to 20% interest, which means that if you owe $100 on a credit card like that, you have to pay 20% extra back. So if you owe $100, you have to pay an extra $20 in interest if you haven't paid off that principal. And therefore, it ends up being kind of manipulates people into hopefully saving their money in times where economic activity is too high, or spending more money when economic activity is too low. And as we get into this topic, we'll start getting into a little bit more of the detail at the moment of why interest rates haven't been too effective at stimulating aggregate demand. And there are multiple reasons for that within Australia. If you look at low consumer confidence, our household indebtedness ratio, and a few things along those lines. But we have record low interest rates at the moment. The cash rate is 0.25, unless it's dropped since I've made this video, which is unlikely yet also kind of likely with how much of a train wreck the world is at the moment. And so the cash rate's what the RBA charges banks, and then banks charge us interest rates, and interest rates are also the lowest they've ever been. So the RBA has this charter, and VCAR can ask you directly about this charter if it's in the study design, and it basically outlines what the RBA does directly. So it's the duty of the Reserve Bank Board, within the limits of its powers, to ensure that monetary and banking policy of the bank is directed to the greatest advantage of the people of Australia and the powers of the bank, and are exercised in a manner such as, in the opinion of the Reserve Bank Board, will best contribute to the stability of the currency of Australia, so having a stable exchange rate, the maintenance of full employment in Australia, and the economic prosperity and welfare of the people of Australia. So they're the three umbrella kind of things that they try and achieve. And it's strange because they don't link in, like obviously full employment links directly in with the goal. Economic prosperity and welfare of people is kind of airy-fairy, and stability of currency is also a little bit like, it's not something we look at a little bit in Unit 3, Area Study 3, but it's not something you probably think of too often. But having a stable exchange rate is fairly important because it helps us maintain our exports, and also just gives a little bit of stability to like the aggregate supply side of things and businesses. So the RBA goes through a process of credit creation. So the RBA supplies as much money, as much currency to banks as is required to meet the demand, and the largest proportion of our money is in deposits in different types of financial institutions. So a little question here, when you put money in the bank, what do you think actually happens to it? Hopefully you know already that if you have savings in a bank, what the bank essentially does is loan your savings out to other people and give you interest in return for that. And that's why savings accounts earn interest, even more if you've got a term deposit where you can't touch that money for a certain period of time. And then banks also make money on what they charge. Like if they loan it out to someone else, they charge them interest on that, and the bank makes a higher percentage than you make. So that's what tends to happen. That's how credit can be created. And so banks offer to pay interest to those who save, basically as a repayment for the bank or financial institution using your money to loan as credit to others. And when the volume of credit grows quickly, then aggregate demand tends to increase quickly too, as consumption spending and investment spending often greatly increase when interest rates low and credit is easily available. And this can often lead to higher rates of inflation because spending might increase faster than supply can keep up, which leads to widespread shortages and prices being bid up. The economic theory of monetarism emphasizes the key role played by the volume of money in influencing output, employment, and prices. One of the things we look at with monetary policy is it's most effective at managing inflation because it so quickly can manipulate savings and consumption and investment spending that it can have a massive effect on aggregate demand well, not quickly, but fairly quickly. The impact takes a while to be felt. We'll look at that in strengths and weaknesses in a future slideshow. But it can really quickly affect people's spending or savings and therefore stimulate the economy very, very quickly. Then we also look at the financial sector and capital market. So the capital market involves borrowing and lending of credit at a price or cost, which is called the rate of interest. And banks and other financial institutions, so building societies, managed funds, superannuation funds, credit unions, insurance companies, finance companies, and the stock exchange all play a pivotal role in this market. So the RBA heads up the financial sector and uses monetary policy to help avoid inflation and improve domestic economic stability. So often they believe that once you achieve the goal of inflation, it can help achieve the other two goals. So initially the RBA always tries to achieve the goal of low inflation, and then if that is within the target range, they'll then start trying to tackle the goal of strong sustainable economic growth and the goal of full employment. Recently, there has been some deregulation of the financial sector, which is the removal of unnecessary government restrictions on the activities of financial institutions which expose them to market forces. This has led to far greater levels of competition in recent times, which makes lending more competitive for consumers. If you spoke to your parents or your parents' parents, the interest rates were way higher on home loans and debt 20, 30 years ago than they are now. But then on the counter side of that, the price of houses is exponentially higher. So we're not actually that much better off, or in a lot of cases, we're worse off. Since the GFC, measures have also been put in place that banks remain liquid, which means they've got enough cash to cover their debts. To prevent banking failures that occurred in the USA, basically what happened in the GFC, the USA banks, when people started trying to like panic take out their money, didn't have that money, and a lot of banks just collapsed and people lost all their savings. And there was no real law to prevent them from doing that. Whereas in Australia, we have laws to prevent. The banks always have to have enough money to cover what people have in the bank, and therefore they can't borrow more than they can give, and therefore they always have to have enough money to protect your money, so you're always going to have access to your savings. So some of the aims of monetary policy. So the first main thing they try and achieve is the goal of low inflation, which is achieving a 2 to 3% increase in general price levels on average over the business cycle, or on average over time. The RBA uses monetary policy in a counter-cyclical way to either tighten its stance, which is set higher interest rates when inflation is too high, or loosen its stance, which is lower interest rates when inflation is trending below the goal. So as of March 2020, the RBA chose to decrease the catch rate to 0.25%, which is obviously trying to stimulate the economy through lower interest rates. for many, many reasons, particularly the low consumer confidence and the fact we're in the middle of a pandemic. Not a lot of people have been borrowing extra money to stimulate the economy further because people are worried about the future and worried about not being able to pay that back. Then they also have the pursuit of the goal of strong and sustainable economic growth, as well as the goal of full employment. And only once the goal of low inflation is achieved will the RBA focus on these other goals. So when economic growth and full employment are falling short of their targets, while inflation is under control, the RBA may take an expansionary approach, so lower interest rates, which encourages both consumption and investment expenditure, which increases aggregate demand. So for businesses, this can lead to both economic growth and full employment being achieved, because if they're investing more and investing and expanding, they may need more labor resources to satisfy that expansion, therefore helping with full employment. But also, if they're investing and expanding, that's going to lead to greater levels of production and therefore greater levels of economic growth as well. All right, that is it for this introductory into interest rates, monetary policy, and how it is used to achieve some of the goals and what the RBA's charter goals are. If you have any questions at all to start off with, feel free to send me a message and ask. Next time, we're going to get into how the RBA uses open market operations to actually change the overall catch rate or interest rate, which is where things get a little bit more complicated. Other than that, yes, so feel free to leave a comment below, send me a chat, send me a message, send me an email. My email is in the description below. But I hope you have an excellent day, and I will see you next time. Goodbye.